everyone. I would like to officially call to order the Finance Committee meeting for January 22nd. We'll get to the minutes in just a second, but I did want to make a couple of introductory comments. In particular, I would like to welcome our new Finance Committee members, David Burson to my right, and Todd Bonet and Bruce Leigel, both of whom are online. So welcome, guys. Appreciate your being here. Just as an observation, we had a very strong response from the community in terms of interest in serving on the Finance Committee. That was great, and there were a lot of talented people, and I had the pleasure of welcoming 3 capable new members, but I also had the job of telling the other people who weren't selected to stay interested and attend meetings, and there may be an opportunity for them in the future. So we're delighted to have our 3 new members, and we're delighted by the community response. I think that's all I wanted to say. I think we're going to talk later on in terms of the schedule, Dale, or not? We're going to talk.
Not particularly.
Okay, so there is no meeting scheduled for next month, at least not currently. Part of that is that the audit will be going on and so on and so forth. But I would have a request for all of the committee members, new and old. And that is, I would appreciate it if you could think about what you feel should be the priorities and focus of the Finance Committee this year. And Dale, I would ask you to do the same as a member of the committee. And then we can take those all together and we can sort them out and then agree on a set of priorities for this committee. And it'll have staff input and it'll have committee input, and then we can sort of see where we are and what we want to try to accomplish for 2026. Okay, the minutes have been distributed. I've reviewed them. Dale has reviewed them. I think we got a little feedback. Are there any issues or questions relative to the minutes from our November meeting? Okay, hearing none, I have a motion to approve the minutes.
So moved.
Second?
Second.
Discussion? All in favor?
Aye.
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 Okay, minutes are accepted. Dale, over to you.
Yeah, I think the first portion of this will be our quarterly report from Morgan Stanley on our investment portfolio. So I'll turn it over to Dana and Stuart, and for the new members, they are our key contacts for Morgan Stanley and everything we do within the investment portfolio.
Great. Thank you, Dale.
Yep.
Can everyone see my screen right now?
Yep.
Yes.
Yes.
You
Okay.
might increase it a tad once we get moving.
Sorry, say that again, Paul.
You might increase the size a bit.
Perfect.
Once we get moving here, we'll need that.
Will do. And for the new Finance Committee members, I'm Dana Hensel. My colleague Stuart Thomas is our Chief Investment Officer here. We have been your co-fiduciaries, and we've been overseeing your portfolio, your reserve fund, and then 2 other shorter term portfolios for the past, I think we just marked about 3 years now. So we really appreciate the partnership. This, we provide a report quarterly, and this quarter is our look back at the full year of 2025. We've been working with Dale and with Paul to try and come up with some sort of summary table up front. The report we send is long, it's 100 pages. There are tons of details on performance, attribution, holdings, but we're trying to come up with like a one-page snapshot that you can look at and kind of just see how the portfolios that we manage on your behalf are doing and have been doing. So we welcome continued feedback on this. I will just note very quickly that in the report that we sent out yesterday, on this fixed income index line, we were showing the aggregate intermediate index. So we have corrected that in the version that I'm sharing here. It was only the index return on the fixed income portion, and we will send that to you so you have for your files and so you can post internally. But
So
taking a
Dana,
step,
sorry. I can't see the screen is very far away from me, but I have the hard copy in front of me. What is the number that you're referring to?
yeah, so for those of you who can see the screen, we were showing on this row right here, which is an index, it's a comparison, not how your portfolio did. We were showing an aggregate intermediate bond index, and we have switched, if you'll remember, we talked about just using the broader Bloomberg US aggregate bond index. So the numbers in this row were slightly lower because of the index returns. We've corrected it here, and what you'll see is very kind of inline performance versus the index on the fixed income side.
So what are the new numbers?
Okay, so for the Bloomberg US aggregate index for the fourth quarter return, it was a positive 1.1%. For the full year to date through fourth quarter 2025, which really reflects a full year 2025, it was plus 7.30%. And then for the since inception annualized return, which reflects about 3 years now, 2023, 2024, and 2025, the annualized return has been a 4.28%.
Okay, great. Well, since it's interesting that you focused on those numbers, thanks for those changes. Because the one number that, and first of all, thank you for this. This is very helpful, and I think it'll be helpful to the board and our members to have, a quick and comprehensive snapshot of our returns. So the one question that I found surprising was the since inception annualized return for the fixed income portfolio. So now I understand that the number is 4.28, right?
Can I correct very quickly? 4.28 is the index. Your portfolio actually outperformed since inception by about 120 basis points.
Okay,
so if you look at the row above,
the 2.02 was the mistake.
Correct.
Okay, my question just went away.
Okay. Yeah, no, hopefully when we look at these numbers and we take a step back, fourth quarter was certainly more volatile than second quarter and third quarter when we met with you. But all in all, it was still a positive return quarter for the broader equity and bond markets. When you look at what your reserve fund portfolio, which is about $26.5 million. When you look at the return for that portfolio during the fourth quarter alone, it was a positive 1.6%, right? Not bad, not as good as what we'd seen in prior quarters, but very much in line with what the broader markets did. Taking a step back, our target allocation for this portfolio is 40% equity, 60% fixed income, right? And our team at Morgan Stanley has a range that we can manage within that overall allocation. But we generally try and keep it pretty close to the 40-60%. You'll see right now, as it sits as of the end of the year, and even a little bit more so now, we are slightly overweight equities, and slightly. So 41%. It's not like we're moving up to like the 50% equity range. Very slightly overweight equities. And what you're going to see over the last year is that very slight overweight has been one of the key contributors to positive performance within the portfolio, positive outperformance versus benchmark. When you look at the full year 2025, and we will get into some attribution in this to this shortly, the portfolio returned over 11%, 11.68% for 2025, which we're happy about. We will say it did underperform our benchmark index, which is a composite made up of three underlying very large, broad market indices, by about 1%. And we'll talk to you about why that underperformance occurred. But when you look at the broader mandate of this portfolio, what we are trying to do is to outpace inflation and specifically construction cost inflation. So when we look at the number that you use in your reserve fund study, it's a 4.9% inflation benchmark, right? And that's kind of what we're using as a guiding factor on the goal of this portfolio. And, certainly during 2025, we well outpaced that. When you look at since inception, so since our team's been working with you, which is now 3 years, 2023, 2024, and 2025, the annual return for your portfolio has been over 9%. So certainly we are, it's been strong equity market returns, right? And we've seen that really play through positively in terms of overall attribution and adds to your portfolio. When you look down at the other kind of two buckets of money that we help you manage, your general fund, operating fund had about $500,000 as of the end of the year. Again, this fluctuates based on operating cash. But when you look at the full year for this portfolio, about a 3.8% return, 4.2% since we started working with you. And that's really just in line with interest rates. And so, the goal of this is we're not looking at outperformance. This is more of a cash management, cash plus management type strategy. And then lastly, the designated fund, $5.2 million as of the end of the year. This designated fund, we're allowed to take a little bit longer investment duration exposure. And so what you'll see is kind of in line with that since inception. You've earned about an extra 12, 15 basis points on the designated cash fund by having a little bit more flexible mandate and being to invest a little bit further out.
Hey, Dana, this is Todd. I guess the question I've got is for the fourth quarter, is that really the 3-month T-bill around 1%? The index.
Yeah,
Yep.
it is.
Isn't the T-bill, trading north of 3% now? I'm just curious.
It is, yeah. So the target range, I think, from the Federal Reserve, we're now, I forget if we're in between 3.5 and 3.75 or 3.75 and 4. This is just
Right.
the quarterly figure itself. So annualized, the run rate is closer to that 4%, which is in line with what rates have been here over the last 12 months or so.
Okay.
It's a
Dale,
prorated return, right, Todd? So
okay.
you don't get 4%. It's a 4% annualized rate. So over any quarter,
Okay.
you'd get a quarter of 4%.
Okay.
Hey,
that helps.
Dana, I had a question. So you guys outperformed the fixed income piece, which is really nice. And I don't know if you have broad brush strokes in terms of why that was from an attribution perspective, just very broadly. But I also see you guys underperformed in equities, and I'd love to hear, I know you talked a little bit about this, but I mean, in absolute terms, you still underperformed in equities. So I'm just curious, is it your managers are more conservative, or was it? Yeah. So I'd just like to know. I mean, it doesn't have to be detailed. I'm just curious.
No, I think great questions. And I'll hit the equity part, and Stu, maybe you can hit the fixed income part. Yeah, I'll start with the underperformance and give Stu the fun outperformance portion of it.
Dana, could you increase the size of the screen for us?
Yes, I'm sure this is teeny tiny. Okay.
Well,
we do provide a little, and Brand, this will be a little bit long-winded, so I'll get there. But we do provide a little bit of additional portfolio information for the full year recap. One, in this upper right-hand corner, this is on page 8 of our report. We show kind of quarterly performance for the portfolio in blue versus quarterly performance for the index benchmark, which again is like a composite of the Bloomberg Aggregate Bond Index, the Russell 3000 for US large cap or US equities, and the MSC ACWI ex-US for international exposure. What you'll see on a quarterly basis is that we slightly underperformed the benchmark in 3 out of 4 quarters. What we also have noted to the left is that this portfolio continues to be, since we've been managing it for you, a little bit more of a downside protector. So while overall returns in 2025 were positive, if you'll remember in April of this year, of 2025, we had pretty significant drawdowns. The tariff tantrum, some people call it. The max drawdown for the IPS benchmark was about 6.5% during that April timeframe. Your portfolio was down about 6.2%. So we're not talking major differences, but in general, the portfolio is set up to be invested in more high quality managers on the equity side and managers that tend to protect a little bit more on the downside. That's good and bad. The bad is that on the upside, when you saw US equity markets up, double digits, 17, 20%, some of the managers that we have don't always keep up in that type of market or type of environment, especially when quality managers are not in favor. But when we look at the attribution overall, very high level, we try and show once a year this kind of waterfall to say, listen, the benchmark return for the portfolio overall was 12.768%. When you look at your portfolio return gross of fees for the year, you are at 12.07%. So bridging the difference, the biggest detractor was really underperformance for one of your international equity managers during the year. So it was one manager underperformance there. All in all, results in about a negative 0.4% return versus the IPS benchmark index. So on the equity side, we did underperform. It's a combination of quality managers, but really selection in one international manager within your portfolio. And that's an emerging market manager. So it's not high exposure within the portfolio. But I'll let Stu speak to more the positive side on the fixed income piece.
Yeah, and I would just add too, we had a little bit of underperformance as well from one of our domestic small and mid cap managers. To Dana's point, also a quality focused manager as well. And it was the kind of environment that, particularly following Liberation Day back in early to mid-April, where low quality stocks outperformed higher quality stocks on a meaningful basis, like 20 to 30% over the course of the rest of the year. And so it's just not the best kind of environment for the managers that we focus on for a portfolio like this that are intended to try and keep pace during up markets, but really protect on the downside. On the fixed income side, we did have outperformance from Sage, your actively managed fixed income manager. Another good year for them. This is multiple years in a row of outperformance relative to our fixed income benchmark. The key drivers for outperformance relative to the benchmark here over the last 12 months for the fixed income portfolio were an overweight position to agency-backed mortgage securities relative to the benchmark. I know we've talked about this in previous quarters. The key structural difference between this portfolio and our benchmark index, we have an underweight position to US Treasury securities and an overweight position to agency mortgages and commercial mortgage-backed securities. So a little bit more yield in the portfolio with similar levels of credit quality. And again, for this portfolio, we're talking about mortgages that are AAA and AA rated mortgage securities. So nothing in like the BBB or below quality threshold, offering a yield pickup relative to just owning US Treasuries outright. And we talked about this in previous quarters as well. The rationale for Sage owning mortgage-backed pools over corporate bonds to get that extra yield relative to the aggregate bond index is that spreads within the corporate sector have continued to compress. So from a valuation standpoint, mortgages continuing to look relatively attractive versus just owning outright corporate bonds. And that was the key differentiator in terms of returns relative to the benchmark here over the last 12 months, which we're pleased to see.
Guys, I had a couple of other questions. So in terms of the inflation benchmark, there's a since inception number, but that's the only period that the benchmark shows up. Is the benchmark only published semi-annually, or how frequently can we grab that benchmark for use on this table?
Yeah, and Paul, this is where we'll continue to get your feedback on how you want to show this. We use that benchmark, we tie that to your reserve, the figure stated in your reserve study. So it's updated annually. This reflects the most recent number, 4.9%. The reason we only show it in this like kind of annualized since inception is because our thoughts was that it was like a more of a longer term view on the approach for outpacing inflation. It'd be fine if we added the 4.9% figure because it is an annual figure in this year-to-date column as well. We just, for what we're putting that there to say like over time, right? Portfolios are going to have ups and downs, but we are trying to over the medium term outpace 4.9%. We're not trying to do it within the quarter, right?
No, I appreciate that, but I think look at if the benchmark, all of these numbers need to be read in the context of the period that's covered, whether it's a quarter or a year or 3/4 of a year or 3 years. So I think everybody understands that. But to the extent that we have the benchmark for fourth quarter, year to date, and since inception, those should be populated in the chart.
Okay, it'll be a static 4.9. So we'll just put the 4.9% here, and then we can take 4.9 divided by 4 to give a rough estimate of what a quarter should be.
Why would it be static across those periods?
They're only doing it once a year.
Question is whether
It's an index. Brand, this is like a commercial construction index, isn't it? It's available across periods, right?
So just to be clear, the guidance or the edict for the investment advisor is to meet or exceed the inflation rate as indicated in our reserve study report. That is a once a year calculation, rolling 10-year average. It's 4.9%. And that's what we use for the entire investment year as well.
But is that fair enough? It's in the reserve report, but is there a published index that we grab to put in the reserve report that also is published monthly, quarterly, semi-annually, or annually? That's my question.
I think we could, Paul, to your point, I think we could pull this index, which we believe is one of the reference indices that's used to help support the 4.9% that's published in that reserve study. This is this index is available on a monthly basis, and we could, if you all would like, we could add to this table essentially like a return estimate. Well, not estimate, but we could calculate the return of this specific inflation index that's published monthly and include that as alongside of the 4.9% annualized figure. That it is updated on a monthly basis. I think usually with like I don't know, I have to check if December's been updated yet. It's usually like a 2 to 3 week lag after month end, but it is available on a monthly basis. So we could update and include this in a tabular form if you all had interest.
So I'm not sure I'm on the same page. Our IPS calls for the investment advisor to meet or exceed the target of 4.9, which is a rolling 10-year average. So again, it's thinking about the long-term nature of these assets and the investment strategy. So my orientation is that if we're going to start talking about having that metric over a quarter, over the 6 months, over a year, then we're kind of establishing a moving target and not really looking at the long-term nature of these assets.
As someone who looks at the inflation numbers constantly and in detail, and if you put the chart back up there of the construction costs, they're highly volatile. And so in any one quarter, the number may not be very reflective of what we're going to face over the year.
Or 10 years.
Or 10 years, we need to talk about that. 10 years may be way too long,
Right.
a moving average. But you can see that the monthly numbers can be quite volatile. And so looking even back over a 12-month period, while it reduces the volatility in any one month, the 12-month change can still be volatile. So it's probably not that useful. Now,
Yeah.
again, we may want to decide if a 10-year average is too long.
Okay.
Yeah, so when we first looked at this index, I would just throw out there, that was exactly the problem we faced. It was a couple of years ago, and obviously things were very volatile. So question is, do we want to use like a 5-year average, a 2-year average, a 10-year average? And part of it's also, whipping around if we're using this as our benchmark minimum return, it's whipping around what the intention is for the reserve manager. So, 10-year, just so you know, like the logic for the 10-year was to really smooth out the return over a longer period of time, because these are longer assets. But I mean, the question would be, if we got into a deflationary period, then, this may not be, 10-year may not even be appropriate, because you're incorporating data that's so long back. So I don't know what the right amount was. We kind of came to the conclusion that we looked at it over various time periods, and 10-year was the most reasonable one. So, but anyways,
Okay,
that
so
was the
is
background for it.
So is the 4.9 year, I'm looking at the chart, is the 4.9% 5 years or 10 years?
It's a 10-year rolling average.
It's a 10-year
Yeah.
rolling average.
It's a 10-year rolling average. Yeah, that's as I said, we went to 10-year because even over the past 5 years, we saw significant COVID related spikes, right? So then it was like, is this reasonable? Is it reasonable to assume that we're going to be, at 20% inflation or 15% inflation, and we're going to factor that? But as I said, there's a variety of ways you can do this. You can do a 10-year plain average, which is what we have. You could weigh it more based on the past year or 3 years, or you could just do a 3-year, 5-year average. But again, the 10-year was to reduce the whippiness in the index.
Yeah. Okay. So short term, let's add a footnote so that it's clear what the 4.9 actually represents. The other thing that I wanted to mention, especially for the benefit of the new committee members, is in our investment policy, reserve investment policy statement, take a look at it. There is a little bit of a contradiction. It talks about two things. One, it talks about the objective, which is to provide the association with a hedge against construction inflation. But then it also talks about ranges of debt, of fixed income and equity. And if you look at the return numbers since inception, the total portfolio return, by the way, just as an aside, these numbers include fixed income mark-to-market?
Yes.
Yes.
Okay. So if you look at the since inception number, the total portfolio return net of fees is 9.12, whereas the inflation benchmark is 4.9. Now a member might look at that and say, wow, that's outstanding performance. But I wonder if not only are we investing as a hedge against inflation, but we're investing to make money. And something that the committee should think about is, and so the conflict is that if you look at our debt equity bands that are prescribed in the investment statement, there's a minimum equity of, I think, 25 and a maximum equity allocation of, I want to say 55, something like that. And as you heard earlier, we're currently 60-40 fixed income. So we're well within the bands. We have 40% equity. And I suspect that if we were at a lower level of equity allocation, we would still, now, I don't know how much lower, but we would still, over since inception, last 3 years, we would still have exceeded the 4.9 benchmark. So
We talked about this
we have
last time,
talked about it.
and I think on slide 84, 85, isn't that where we have some analysis around changing the composition and what that does on the returns?
Yeah,
Exactly.
another thing, for the group to think about, but I've heard a lot of angst about, having an equity allocation for this reserve fund. What might be helpful to the members to understand is how much of it, when we look at our fixed income dollars, how much of our fixed income dollars, or how many years of reserve fund spend are covered by those fixed income dollars. So if you think about it, we've got fixed income money that's available to probably cover 6, 7, 8 years worth of reserve spend, so that the reliance upon the equity portfolio to actually fund reserve fund expenditures really is pretty low. So I think that might put in perspective, Dale, for the people that are concerned about the equity allocation. Dane, if you could go back to the summary, because I guess one thing I want to, have us focused on is that we've obviously benefited against that target of 4.9% from a higher rate environment in our fixed income portfolio. So if we are facing a declining rate environment, then that's going to, put more pressure, I guess, more reliance upon our equity allocation for performance compared to that benchmark of 4.9. Do you agree?
Yeah.
Or do you think,
Absolutely.
that?
I agree. In fact, we don't need to turn to the slide. There is a slide in here that includes the details on the fixed income portfolio in aggregate, Todd. And I
Okay.
believe the run rate, so the expected yield on the current fixed income portfolio is somewhere between 4.5 and 5, not 4.5 and 5, sorry, 4.5 and like 4.75%. And
Right.
so just on the yield of the current fixed income exposure, it would be under our expected benchmark of 4.9%. And
Right.
it also ties to that slide 85 that Dana had up on the screen, where a portfolio, and apologies for jumping around a little bit here, but like the portfolio in the middle that contemplates a significant de-risking from our current target allocations and only holding 10% in equity, our long-term expected return for that portfolio, which is almost exclusively fixed income, is around 4.5%, which reflects both where current yields are in fixed income markets, as well as the expectation that, particularly for intermediate and shorter term yields, that rates are probably going to go down to some degree here over the next couple of years.
Okay. And again, I'm not suggesting to the finance committee that we change our allocation between equities and fixed income, but I think that's just the reality. The only thing that we might want to talk about is obviously, if we're looking at a declining rate environment, that should be favorable to equities. So the only question I would have is whether or not we would have a bias towards managers that do better in a underperforming market, and switch maybe to managers that do better in a favorable equity market. So, hey, one other thing for, Paul, you talked about objectives for the finance committee. One thing I've always wondered about is, we use this, construction index that's generating the 4.9. Can't we look at our own experience in the reserve fund spend to come up with something that is another measure of what the inflation is? And again, I don't know what percentage of our reserve fund spend and reserve fund allocation is roads, but that to me would be a pretty simple way to look at what the cost increase has been in our road spend, per mile, however we might measure it, Dale, over a period of time. So it's something I'd like to come back to later in the year, especially when we're looking at the reserve fund, is whether or not, we have the capability to look at our own experience rather than a broader market index. Okay, thanks.
Todd, it's Shannon. So we could probably go back and look at a couple of our mass paving contracts over the years to look at like what the oil index did to our road paving, because the oil index is what drives that one. Certainly, we have a lot of wood products. Wood also drives and has been very volatile. That one's going to be harder to compare because the projects aren't similar enough. Maybe boardwalks, maybe.
Yeah.
But
No, I agree. And on some of the non-road projects, and the good news is we're improving what we had before. So we have, in a sense, an inflation element as we, for lack of a better term, change the scope of the project. For example, our trails are getting wider, which is good. Our boardwalks are getting better, which is good. So that's, in a sense, creating a different measure. But it's just something that it might be helpful to take a look at. Thanks.
Yeah, I think the other challenge is when you're dealing with contractors and you're contracting it out, you don't necessarily know what the underlying material costs are. And
Right.
if you're comparing linear feet of boardwalk or whatever, it's difficult to do an apples and apples comparison
yes.
based on the fact that you're contracting both includes the material cost plus any other costs associated with it. So
The one that's
unless your
easier.
contractors are providing you with the underlying cost of the materials, et cetera, it's difficult to do.
Yeah, one thing I would say is, we, and I personally really grappled with what is the right benchmark here, because I think, more broadly speaking, whatever benchmark or minimum inflation we're targeting that drives the asset allocation in my mind. If you're saying it's 2%, you don't need equities ever. You're fine in treasuries for the life of this. So this index really drives, I think, the composition of the investment portfolio. And for us, it was just a struggle because previously we had used the reserve manager. To your point, Todd, the reserve manager was giving us his estimate of inflation, which in actuality was just CPI. And it's like, well, CPI is not a good metric for the construction. And so we looked at a bunch of different indices to use and obviously the whole point here was to be objective and to find an inflation index that was relatively reasonable for our area. And we looked at like regional indices and so on, but also, objective. So it wasn't somebody just, pulling a number out or saying, okay, well, I just feel like it's this, or historically it's been this. So
Right.
personally, although like I helped kind of draft this index and put it in there, I there's many flaws to it, and you could argue there's a better inflation metric, but it's just a challenge to find one that's objective and somewhat tied in here.
Yeah.
But I think it's really the key part of this whole piece. So
Yeah, I agree, Brandon. But also from a messaging standpoint, the fact that we can point to something, that's simple and that is tracked as an index for the members, that's a simple message. I mean, we're in the weeds here, so it's a little bit different for us. But again, the other thing in a declining rate environment, to your point, we don't want the benchmark to, force the wrong decision too. And so, but it's something we can come back to. But I appreciate the discussion. Thank
So
you.
I do think that's one of the things we talked about last meeting was looking at the next 12 to 18 months, what should the right allocation be? And I don't know whether we got any further on that discussion or not. And maybe, again, one of the thoughts I had was take a smaller group of the finance committee, people that are knowledgeable around this, and go off and kind of, as we prepare for the next reserve study, think through these issues of asset allocation, inflation index, et cetera, so that we're not just always talking about it every committee meeting. It just seems to me we should try to create a small group of experts within this committee and go kind of at least once a year, if not more frequently, kind of confirm all of this.
Right. But I do. Yeah, apologies. I do recall the
Hey,
angst.
Todd,
Todd,
Yeah.
we've got,
hang on,
David
hang on a
wants to
second.
speak.
I'm
Okay.
concerned if we're making investment decisions under the assumption that interest rates will go down. They may go down. They may not go down. And inflation may go down. It may not go down. I think we need to be very careful about changing investment assumptions on the basis of those forecasts. All forecasts are wrong,
Yeah,
even
no,
mine, but they're wrong either by little or a lot. But sometimes they're wrong by a lot and in the wrong direction.
Well, that's why there's always been a perspective of taking the long review.
I understand.
And not sitting here once.
Exactly.
Finance
Agreed.
committee meeting, changing our, asset allocation. So
Agreed.
I think everybody agrees that it's almost, Brandon's talked about in the past, it's almost like an insurance company portfolio where you have these long-lived assets. And what we're trying to do obviously is asset liability match in a way, or in terms of what our.
Okay, could I interject here? Look, we're taking up a lot of time from our advisors here. Morgan Stanley guys, what else would you like to highlight in terms of your report? And none of us has really had a chance to go through it, but what other highlights would you like to emphasize for us this morning?
We were actually going to turn it over to see if anyone had last questions. We hit the high points. We wanted to give you a high level attribution for the portfolio performance over the last year. I think all in all, one of the questions that came last meeting was what's Morgan Stanley's outlook on equities, and certainly we echo the thoughts of like taking the long-term view, right? That's the point of this portfolio. But in general, there is a reason why you're looking at 41% instead of like 39% equity, because in Morgan Stanley's view, they think a very, very slight overweight right now is kind of where their head is. I don't know, Stuart, anything else that you'd highlight on Morgan Stanley's side?
Just that there's a broad acceptance that valuations across various markets, including equity and fixed income, are relatively stretched versus historical averages. But on the balance, equities actually are less expensive than fixed income markets, given the continued compression in spreads across various areas of the fixed income market. We have a page in here, I think it's slide, it's in the market review. Yeah, the fixed income one, there we go, where we just highlight just some of the spread compression that we continue to see. It's like even since we began working with you 3 years ago, looking at changes in AA spreads, double B spreads, those kinds of valuation specific metrics for fixed income markets. And we included a chart last quarter on this as well that looked at declining spreads across various areas of credit quality within the fixed income market. And so the viewpoint is maintain a balanced approach, don't veer too far from targets. But if we are going to have slight deviations from a standard portfolio, it'd be very slightly overweight equities. Make sure that we have full exposure in international markets, given the run up in domestic large cap stocks in the US, very slight overweights to small and mid cap equities within the US equity markets. And then the trade-off is if we're going to have that exposure, focusing on managers that tend to do well in down markets, although that was a detractor in the last 12 months.
Yeah, I've got one last question. What is the process we go through when to evaluate manager performance? Again, I think back when I've been involved in pension and 401k committees. There was a purely mechanical process that if A, B, and C happened, the manager was bounced no matter what. What is the process that we go through to evaluate and consider bouncing a manager?
Yeah, Todd, good question. And we get this question a lot, Dana and I, we work obviously with portfolios like this, but sit in on a lot of 401k and pension meetings as well on a quarter by quarter basis. I have a couple today, actually. So it's a combination of both quantitative and qualitative factors for ongoing manager evaluation within this portfolio or any portfolio that we're advising on. First, I would say, before speaking at length about the active managers, in general, our viewpoint is we want to have good balance within this portfolio and other portfolios, whether it's a pension plan or a 401k menu, between active and passive managers. So we don't need to go to the slide necessarily, but like slide 28 of this presentation and 29, I believe, provide details of our underlying managers within the portfolio. What you will find is a balance between active and passive exposures. That's a fundamental viewpoint of our organization, that we want to be cost efficient, have broad market coverage, and then have a balance of active managers in there as well. For the active managers, there's two components. We have, somewhat to your point, like essentially like an internal scorecard, a quantitative scorecard that's evaluating manager performance. It is weighted primarily towards medium and longer term performance, both on an absolute and risk adjusted basis. Not dissimilar to what you would hear from other consulting firms or other firms that are looking at this on a quarter by quarter basis. So we have those quantitative metrics in place. And to your point, Todd, if they reach a certain threshold, we'll have internal flags come up within our system for those managers. The qualitative component, which complements it, is trying to evaluate and understand how managers are going to perform in different market environments, forming expectations around performance in different market environments, back testing that so that as we progress year in and year out, depending on market conditions, we can match up those expectations with actual results. So if I look at like our two underperforming managers last year, Earnest Partners and GQG on the emerging market side, those are both quality focused managers. It was a low quality rally we would expect underperformance. We didn't like the magnitude of underperformance, frankly, from those two managers. And so we're getting closer, frankly, to replacing those, but we're not at that point yet, given the directionality of markets was in line with what we would expect for how those managers typically perform. So it's a balance of the qualitative and the quantitative. We absolutely have an internal, like quarterly scorecard, essentially, that is rank ordering managers based upon a range of factors tilted towards the medium and long term.
Okay, I have my final question. There's been some drama around Fannie and Freddie and also around credit cards. We have a significant portion of our fixed income portfolio in mortgage-backed securities, and we have a little bit of our portfolio in credit cards. So I have no idea what's going to happen in those two arenas, but I would just ask you guys to keep us posted in terms of what your thoughts are. Obviously, you have deep expertise in both sectors. I don't know what privatization means in terms of the value of our portfolio, et cetera. I don't know what an interest rate cap means in terms of our credit card portfolio. Maybe good, who knows? It's something that we want to stay alert to. And if there's information that you think we should have, because it's a significant part of our portfolio, we want to hear from you.
Of course.
Absolutely.
Yeah, we will keep you up to date quarter in and quarter out as it relates to how the fixed income portfolio is matriculating from an asset allocation standpoint. And if we are making changes within that portfolio, the rationale for it. And so, we'll 100% keep you all updated there. Again, to reaffirm what we chatted about earlier, our underlying fixed income manager, Sage, continues to have strong conviction in the relative yield pickup for agency mortgage-backed securities. Again, we're talking AAA and AA rated tranches of those securities, so the highest quality borrowers relative to just owning outright corporate bonds, given the spread compression in that market. If their viewpoints change, though, of course, we're going to bring that to you all. And same comments as well on the credit card receivables that we have in the portfolio as well. Again, high quality tranches, 3 AAA exposures within that portion of the portfolall. But to your point,
my issues are more sector macro kind of concerns. Yeah. Okay, that's all I had.
Paul, even in the great financial crisis, owners of MBS securitized by Fannie and Freddie didn't lose anything.
Yeah.
In terms of credit, the loans were all paid. So I don't think we need to worry about that. The question is, what happens to yields and yield spreads?
Okay,
Yeah, and actually, like the MBS is like securitized, so it's actually if they were privatized, the bigger issue would be on agency debt, which is these guys issue debt, and that would actually hit their yields. But I think the president's been pretty clear that he's trying to reduce mortgage rates. So I think actually like mortgages have really benefited recently. We see the mortgage basis collapse. So I think the mortgages would be fine, but the agency debt, Fannie's debt, which has a separate bucket within the U.S. Ag, yeah, that would not do well.
No,
Theoretically, in a
it's a good point.
privatization. Yeah.
It's a good point, Fran, and I've actually been talking with Sage and other fixed income managers on this. We haven't seen really any interest from asset managers to own agency debt outright right now. So we don't have any agency debt in this portfolio, and I've seen just across the
Okay.
board, there's been managers that have continued to decrease that exposure. Again, it's not in your portfolio, just in aggregate. To your point, we've seen active managers reduce exposure to agency debt outright because of, just some reticence given the forward-looking environment potentially for those organizations.
Yeah, and then to Paul's other question, I think it's a good one, and but there again, like there's a difference between the ABS, which is securitized and actually might actually benefit by a cap, versus the actual issuers like Visa and MasterCard. They on the corporate side, because they issue corporate debt, this type of cap, if it was really full time, or I don't know if it's only going to go a year or whatnot, but that their debt would also be hurt. So I mean, it's a good point, and maybe a question for Sage in terms of like, are they staying away from credit card issuers, or even Capital One, which is like a really big issuer, obviously in the space and under banks. So, anyways,
I'll ask. Brand's a good question. I'll ask about
good
Capital One.
questions.
We do have some Capital One exposure in the portfolio. I don't want to overstate it. It's not a huge percentage, but we do. Just like most portfolios, to your point, Capital One's a huge issuer. So we have some Capital One bonds in here. So we can ask about the issuers of those debt and how they might be impacted from a financial perspective if that cap were to be put in place.
Okay, any last questions or observations vis-a-vis the Morgan Stanley report? Okay, Dale, you good?
Yeah.
All right, guys, thank you
Thank
so
you, Dana.
much.
Thank
Great
you,
to see
Stuart.
you.
Thank you.
Thanks.
Thank you.
Thanks,
Happy New
everyone.
Year.
Welcome to the new members.
Hey, can I just throw something out there? Is Morgan Stanley off the line?
Yes, I think they are.
Okay. I would just throw out there, like, I think that they've done a good job. But I know people are concerned about the equity allocation and the fixed income allocation, but if we do hit a rough patch in equities, this year, which I wouldn't be shocked if we had some type of correction, I would really like to see them shift their allocation, preferably before an equity correction. But I think we haven't had them in a market yet where there's a significant movement downside to either equities or fixed income. And I think we just really like going forward to Todd's question about how do you like decide to fire a manager or whatnot. It's the same, I think, for us. Like we really have to see that these guys are adding value by doing asset allocation in these more volatile times, which we haven't seen yet. So I'll just flag that for the rest of the year or however long they're on the platform or however long we're using them. We should really like see that there's a value in their asset allocation.
Yeah, and Brent, I do remember the angst, that, when there was the discussion about having the equity allocation, and my recollection is the board almost shut it down. But I think we can do some things by messaging how many years of reserve fund spend do we have covered through the fixed income side. But for those members that end up taking a more conservative investment strategy, we're always going to be criticized in that down market for equity. So I think there's a way to compensate for that by messaging that we can't afford to take a longer term orientation because we have X number of years of reserve fund spend covered through our fixed income portfolio.
Okay. Yep.
Good points. Okay.
I'll be back in 10 minutes.
Dale? Fourth quarter report?
Okay. So from the version I sent out originally, I've made a few tweaks just for headers and just aesthetic type things. I actually added the investment report to the exhibit in the very last page, and I'll update that with their updated version and any updates we have to this. And then once we complete this meeting and I do those updates, we'll post it to the website for the membership. And just so everybody knows, this document and the investment report, this one was posted to the meeting calendar for the membership, I believe yesterday. And then the investment report first thing this morning. So I won't go through, the intent of the narrative was to summarize a lot of this document. So I won't go into detail on that, but I would like to just touch on certain areas, and if at any point during the presentation you have questions or comments, those are welcome. Typical balance sheet, operating versus reserve. What I want to do first is touch base on our cash management structure. The operating, checking, and cash, again, my strategy is to keep that to a minimum throughout the year, transferring balances to and from investments in order to maximize our earnings potential. It typically is a week or two out from major expenditures that I transfer back into the cash so that we have enough for those expenditures. I'd like to touch on the bottom left, the designated funds. As we talked about earlier in the investment report, there's a designated investment account managed by the investment advisors. As was reported, that's about $5.2 million. That will not tie to this designated fund schedule because each line item, for example, the first 4 line items, asset replacement dollars, V-Gate, Ocean Park, Preserve, those fluctuate on a daily, if not monthly, if not daily basis, as do the other ones that I attribute earnings from investments to. So my goal is to maintain a balance, and I have accomplished that goal, a balance in the designated account with the investment advisor equal to or greater than this schedule, okay? Also, speaking to the earnings, any earnings in that investment account that we get are attributed to each of these line items based on their proportionate share, except for the named storm reserve. That one is a static policy of the board that says that we maintain a $1 million named storm reserve. So I don't allocate interest to that line item. Any earnings from the designated investment account attributed to a balance greater than this scheduled balance is attributed to the general operating fund, because that's where those funds would have been if they weren't in the designated account. Does that all make sense?
Dale, my only question was, and I'm not debating it, but the unspent flood mitigation quantity is $500,000. So that is not part of the reserve fund. That is in the operating fund.
Correct.
Okay, and that's always been the case?
Well, I don't know before me.
No, but
yeah. So
recently, this isn't a change.
Yeah. So the idea is it to reside in the operating fund once the expenses are incurred on the reserve side, because that's where they're gonna spend the money. I'll transfer those resources over to the reserve fund to cover them. So it's in any given year that we spend money towards that, it's a wash on the reserve side.
Okay. Okay.
Paul, can I ask on the board initiatives? I know we've like talked about this before, but I was curious. Let's say the board has an initiative and they use up like 750,000 of that. Does that get restocked then?
It could get restocked, refunded.
Refunded, yeah. Yeah, yeah.
Funded,
Yeah.
but it would have to be a budget item and
Okay.
specifically approved by the board. So the $1 million is there. The board can designate projects or initiatives, front gate, ARB, whatever, and draw that fund down. To reestablish that fund, it would have to be a specific line item in the budget approved by the board, subject to public scrutiny.
Thank you.
To a certain extent, I will qualify that statement in that the board, in my opinion, and maybe I'm wrong, but could, if it's a mid-year need, emergency, vote to approve an allocation to this fund mid-year.
Sure.
But the
board,
normal practice is exactly what you had mentioned.
That's fine. The board is bound by the budget, except in those exceptional circumstances where a separate decision is made. But yes, okay, so we're agreeing.
So I also wanted the concept of attributing earnings to those line items. It also applies, and I'm not sure everyone here either acknowledges or understands this, but for example, take the reserve. We have income coming into the reserve fund on a daily basis through access fees, the membership assessments, and those earnings all go, or those revenues all go into the operating accounts, right? The cash accounts. With that being said, there's the fund accounting function attributes cash out to each of those segments, like in this schedule, the V-Gate, Ocean Park Preserve, and the reserve. And any earnings off of the operating investment accounts are allocated out to each of those segments based on their proportionate share and the balances that are maintained in those accounts in the general ledger. Does that resonate with you? I just want to make that clear so that, for example, Paul has asked a couple times about when do we allocate actual dollars from the operating cash account to the investment account on the reserve fund. And that's typically done on an annual basis. With that being said, earnings are still being attributed on a monthly basis to the reserve fund for their proportionate share. So they're never short on the earnings side.
The only other thing that I would point out on this page 7, and it's a small item, I don't think it's going to come back to this committee, but it is a board discussion. We have a surplus balance in both the Ocean Park segment account and the preserve segment account. And based on the new right-of-way policy, the association is not providing enhanced services for landscaping, and we're not having a segment assessment either. But accumulated over time are the balances that you see here, 40,000 and 13,000 respectively. And we're trying to figure out a manageable, fair, and appropriate way to return this money. And that is trickier than it sounds.
So this is the current balance sheet that shows Ocean Park and Preserve. This schedule was done after I did all the presentation. So we're closing the books as we speak and sending to the auditors. So it's a little bit, the balances are a little bit off because we've had some activity. But this shows exactly his comment and where we are with regard to those segments.
Okay. Great.
Let's see here. Next. I wanted to touch, again, I'm skipping over some slides, but hopefully those are self-explanatory. If not, questions are welcome.
Could I quick?
Yep.
On page 9, it's a tiny thing, Dale, but I just want to understand our procedures here. So we have a late assessment in the amount of $7,000 that where we've actually filed a lien.
Mm-hmm.
Has this $7,000 been written off our books?
No. We wouldn't write something off until it went to foreclosure or, because it's still collectible.
Okay, so we don't have a policy that a 90-day past due is written off of our books?
No.
Is there any
There
time?
is a policy.
Is there
I
a
think-
time stop?
Well, there is a policy, and I can't remember what exactly it says, that speaks to when something can be written off with regard to these receivables. But for example, part of that $7,000, we're actually going to collect, well, more than half of that, because there was one of the properties was seized by the IRS, sold at auction, and then went to a local court, and they're going to pay out the proceeds from that to us, and plus attorney's fees. So we had probably $2,000 some odd dollars in attorney's fees just in following through. So we'll collect what was actually owed for the assessment and late fees, plus the attorney fees related to it.
Okay, that's all fine. My question was just whether or not, as part of our practice, accounting practice, there is a time stop on carrying an asset that is delinquent.
Hey, Paul, I think you probably have a bad debt reserve that your auditors are going to set up.
You don't want to lose track. So you
You
want to
can,
reserve.
you can keep it, but keep the reserve is going to be something you're going to set up on your books
I
anyways.
believe the policy states that it would not be reserved until it goes into foreclosure, and our practice is not to foreclose because it's not worth the dollars to do so. And this speaks to the fact that our lien process and our collections process is effective. And your concept really isn't a concern, because after this collection, we'll have $2,000 or $3,000 from 2025 assessments and nothing prior to that that is outstanding. So we're pretty current.
Okay.
Page 11. This is simply just to point out Paul's concept of mentioning about the board designation transfer of, the asset replacement dollars started at $2,918,000. We transferred the $1 million, and then it's a reconciliation of how we have incoming dollars and outgoing dollars to get to our current balance. Operating income statement. Again, I think the narrative talks to this. I just wanted to point out that the net change in payables and receivables towards the bottom here of 677,000. The majority of that, and that's just reconciling cash from this statement to what our cash balance is. And that is due to primarily the decrease in our deferred revenue for flood mitigation from, I think it was 1.2 million at the beginning of the year to where it stands now.
Hey, Dale, what's going on with utilities? I mean, we're unfavorable to budget and Q4 forecast.
I think that is spoken to in, Sandcast electricity, lands, irrigation activities, particularly Ocean Park. And we had a below average annual rainfall, so those areas went over budget. And we're continuing to focus on a lot of cost saving measures.
Right.
And Jody, I'm happy to see the bathroom in the lobby is got the automatic switches, which is fantastic. But all those measures include LEDs, automatic switches, programmable thermostats, and then tighter envelopes on our buildings.
So how much of this is what we pay a utility versus, improvements that we're making that we, aren't capitalized? I mean, is this
No,
drive?
these are just like metered type utilities, not
Okay.
improvements or.
Okay, so I'm assuming then that 715 is the current run rate, or is this seasonal?
Oh, it definitely is seasonal and, I don't know what the budget is for next year, but based on the discussions, I think we would probably be containing these costs effectively.
Yeah, and I guess the question I have is, is there an opportunity here for, cost save by spending capital to make things more efficient and more effective? But it'd be interesting to see what we can do.
Yeah, I mean,
And again, I'm a newbie here, so I apologize if I'm asking a question on ground that was previously covered. But are we going to publish an annual recap for the members? I guess what I'm accustomed to in the corporate world is we'd say, here's what our actual is compared to budget with variances, and here's what our actual 25 is compared to budget 26 with variances.
so I responded to you in that we went through a thorough process with that. I get where you're coming from, but I guess I debate as to how much information is too much information. And in the finance committee budget process and quarterly process, we went through that comparison to budget in detail. And from my viewpoint, the forecast almost becomes the new budget for us from an operating perspective. And so we chose to concentrate on that for this report, just because if we start getting into comparing both, that's a lot of information all in this one document. So
yeah, I mean, obviously the forecast changes. We have multiple forecasts through the year, so I wouldn't do that. But again, if I was a member, I'd want to know, how did we end the year compared to what the budget said, and how does the 26 budget compare to what our actual cost structure was in 25? I don't know what others think.
we did all that in the budget process.
But you didn't have the actual numbers in the budget process. It was a forecast, right?
Forecast, yeah.
We had forecast.
Yeah.
So this is kind of putting a bow on it, so to speak, without going back through all that analysis and adding it back in here.
Yeah, I mean, I assume that the commentary wouldn't change much if we were working on, forecast. But again, I don't know what others think, but if I was a member, having a quarterly view is nice. But when you get to the end of the year, I'd want to know what the recap is, full year, rather than just for the quarter.
Possible.
So
I'll
I'll take guidance from the committee on what's the best. Obviously,
I mean,
we'll
we
do
could
whatever we need
always,
to
every
do.
fourth quarter, you could put a slide that shows annual 2025 budget, 25 actual, and 26, right? That wouldn't be.
Sure.
You could stack that up, slide in here, and maybe that's.
Right. And for the
And
most
then-
part, there are some comparisons in the narrative that compare actual to budget. We concentrate more on forecast. But to your point, Todd, forecast is an annual view as of when we did it, October.
Right.
It was updated all the way through. And so again, under advisement, we'll do whatever we need to do to best represent to the membership, and we'll move forward. So
Yeah, and again, I would recommend that.
You could just put 26 budget, right?
Right.
Right there on
Yeah.
My point is adding a comparison of actual to budget in the narrative,
No, I
and
agree.
then
I
adding
agree.
an actual to forecast in the
No, I
narrative,
think
it
if
just
any-
becomes.
I
No.
agree.
Yeah.
So
Yeah,
it's easy for me to add the 2026 budget to this.
Yeah.
So I can do that.
Okay. And again, I think what it tees up is, People talk about we're increasing our spending. Yeah, I think there's an opportunity to change the narrative to say it's an investment we're making. We're investing in our people. We're investing in our, environment. So I think when we show it, it's a good way to be able to say that this is what we're doing to improve our investment posture. Okay, thanks.
Yep. This schedule, I just want to point out that and I will change this for the published version. It should have started with, it may have in a previous report, but it should have started with cash from the cash statement. So this line item right here, will be the first line here to get to this. So I'll make sure that changes. That just is a error on my side.
Dale, could we go back one page? We've had some recategorization of costs. If I look, I take everybody else's points about comparisons, and I went back and looked at Q3 and last year. We seem to have added a line and recategorized, some of these chart of accounts. First off, am I correct? There has been a recategorization. And second, is that good policy? Because from an internal control viewpoint, I don't like recategorizations without discussion, basically.
What's been added?
Well, if you look at other professional financial services costs, last time it was 1.2 million. Now it's gone down to 487. And we seem to have a property and liability insurance line. So I presume those two have been split out.
Yeah.
But again, no one has told us of a chart of accounts change, and I would like.
So this isn't a chart of accounts change.
Well, what is it?
They're
It's a presentation.
They're groupings.
Yeah, no, it's a presentation. But
It's not a chart of accounts.
But we use these for analytical purposes.
So in the last quarterly
So
meeting.
I don't like a change, put it that way.
Okay.
Okay, but in the last quarterly meeting, the group indicated that they needed more detail from what was this in the
Okay, you
previous
could have
report.
explained that. Dale, I'm not getting at you.
All right, well, you're
just-
raising the question, I'm answering.
Just expressing.
So it's not a chart of accounts change. The chart of accounts hasn't changed.
Okay,
The groupings, I've split out several areas.
but
And there was
A request.
a request that I acted on.
but you haven't explained it. Okay,
Well,
I would have preferred
I
you
just
to
did.
explain it.
I guess the explanation is when the request was made, Larry.
Okay, cool.
Okay, keep going.
Hey, Dale, one question is, I recall that when we did the budget, we had a placeholder of, I think, 400,000 for the ARB spend. Where in the budget numbers it's
So this is
there?
the 400 down here in the capital improvements.
Okay,
The 40,000 represents the V-gate enclosure that was
okay.
implemented.
And then so that's 40 of the 440, and then the ARB is the other 400.
That was kayak, right?
That was kayak.
The ARB was
That's-
200.
That's moved into the 2026 budget.
Yeah,
But where was it in the 25 budget in these numbers?
In the capital improvements.
I thought that the 400 delta was
Or what?
Cinder
It
Creek.
was 200 for ARB in salaries. It was in salaries.
But we made a major capital expenditure at the V-gate, right?
The 40,000.
So we actually spent 40,000.
Yeah, the 400 was for the
Kayak
Eagle
storage.
Point kayak. storage.
Oh,
Yeah.
okay.
Okay,
The 400 was kayak storage, so the ARB was somewhere else.
The ARB was 200. in
ARB
in
is
salaries.
was 200 grand in the salaries
Right.
as a placeholder.
okay. So I guess the way to look at it then is, the favorable performance of 8 against 8.6 in payroll expense, 200 of that is the ARB variance.
Right.
Okay,
Which
thanks.
I believe is in the narrative.
Yes.
Paul, maybe this is like not the best venue for this, but I was just curious, because the property I own on Kiwa, we've been approached by both KICA, ARB, and Toki, I don't know what I'd pronounce it, but in the town of Kiwa, apparently they're gonna have an ARB as well. Does this, our funding or our costs associated with KICA's ARB changing now because there might be two ARBs from what I understand? Or is it we're just moving ahead with the plan for the ARB? I'm just wondering, do we like change any of these, since we're talking about ARB, do we change any of these costs associated with it?
So, okay, let me try to, I mean, this is a monster topic, but let me try to.
Yeah,
give you-
sorry. Sorry, I just I don't know if it's
okay.
appropriate.
It's a
but,
good, it's a
I
good,
raised a question.
hang on, it's a good question. Let me try to answer it. So, we have yet to, construct a formal, ARB budget because we have yet to construct a formal ARB. That is something that is on the agenda, as we speak. So, that is going to be done. That work is going to be done. We definitely, then there's a separate business issue that potentially the town will have an ARB covering certain kinds of properties, and the association will have an ARB covering certain kinds of properties. That hasn't been sorted out yet. That's a live board topic that is being discussed and deliberated on. No final decision has been made. There's going to be communication. There's going to be a workshop with the community. So this is a big topic. Part of that will have to be an explicit budget creation for whatever vision of the community ARB we decide to structure.
Okay, thank you very much.
There was
Thanks.
An estimated financial forecast in the November 24 work group deck.
There was.
So is that the basis, or?
I mean,
Again, I feel like if we sent something out last week asking members for feedback on that potential resolution, and I'm in favor of it. But I don't know how you can necessarily ask members an opinion about something if you don't give them more context or information. I understand that it's early days,
yeah.
But that deck from November 24 had some numbers in it. The question is, are they still relevant?
Yes.
Would people benefit from getting an update in terms of what that looks like?
Right. And it's a fair question. And what I would say is the phase 3 report does have a preliminary estimate of KICA costs, which you're referring to. And I forget, it was either $400,000 or $600,000 annual deficit, final run rate kind of approach. We have not updated that analysis. I think we will need to update that analysis. I wish it weren't a deficit, regardless of size, speaking as the treasurer, but there has been no change to that joint task force estimate of run rate costs for the community.
Okay. My next slide is more pertaining to the reserve. Same general layout concept for the reserve fund on the cash statement.
So sorry,
Go
can
ahead.
I ask you to flip back to page 17 for a second, which is the operating fund pinwheel. What is administrative? The $414,000. What is administrate? What does that mean?
It's everything that it takes to run the office for the most part.
Like paper?
Yeah.
Everything other than salaries.
Right.
Not IT, not salaries. Supplies.
Yeah.
Supplies?
Supplies, overhead. I mean, I have a detail off the top of my head. I don't know exactly every single item, but yes.
Okay, go ahead.
So the reserve fund, it's same layout, same concept. The beginning and ending cash is all restricted. So there's no sense. It's vast majority of it is in investments. The cash that isn't would be any operating cash that's attributed to the reserve fund, or cash that within the investment accounts that are their available funds for activities within the investment accounts, but it's minimal.
Okay.
And then again, the change in balance sheet items with regard to the reserve fund that gets it to the ending cash. And then the reconciliation to GAAP, basically for the reserve fund, is the unrealized gains and losses. And the unrealized gains and losses as of 2025 was the $2 million that gets us to a total net surplus for GAAP of $6,513,000. Let's see, if you go to, so this balance sheet for the reserve fund, this second to right column, that includes the unrealized gains and losses, and that's the true value of the reserve fund, right? And if I go to this slide, it takes the unrestricted cash, gets you to the reserve fund balance, and that's what I will be utilizing to determine the percent of deterioration funded. And in the past several years, we've used the cash basis. I use the cash basis. We've determined that it needs to be the full value, including unrealized gains. For example, what connected that dot for me was if we had a complete catastrophic event, we would sell off all of our assets, and this is what the value would be. Therefore, that's what we would have as resources to fund replacing those assets, right? So percent of deterioration is 98.5% estimated. Now, I caution that number only because the denominator in that calculation is the deterioration number, which is done on an annual basis with our reserve study process. And that's bound to change just because of all the activities that we're doing year in, year out, right?
Yeah,
so,
plus the unrealized reserve down too.
Absolutely.
So
Absolutely.
Can I just hit a general point? I mean, if you look, KICA has generated cash of 6 million in the year overall, if you compare opening balance sheet and closing balance sheet. So we generated 6 million cash, and that's fine because we need reserves to go up over time. But if you look here, I mean, we're way short on drainage expenditures, 1.4 budget versus 879. Street surfacing, 2.5 million budget, 1.7. And if you look at overall uses of cash, yeah, we were budgeting 7.3 million on this reserve account to spend. And we've only spent 4.9. Do we have an inability to spend on refurbishing, repairs, replacements, and improving our facilities?
Yeah, Larry, I mean, I had a similar question for, I guess, Shannon and Dale. Is this indicative of that we don't have the right resources? Obviously, these are projects that
I'm
management.
asking the same question, yeah.
Yeah, I mean, do we need to be thinking about whether or not to build out, the organization that's responsible for executing these projects?
As I say, I know we need to contribute and grow our reserves, but really to generate 6 million in the year when the overall intention is to, okay, contribute to reserves, but essentially break even on operating. I just wonder.
Well, I guess it's a question of whether it is a function of staffing or.
I know, but I think it's a concern.
I would
like an answer. That's all.
I would clarify that to be it's 4.5 million, not 6 million, because 6 million of it is unrealized.
Right.
But we've still grown assets. Yeah,
but
I understand what you're saying, but
it's
still
still
grown assets.
Okay. Jody?
Yes, so in the presentation, there are explanations that relate to the question that you've just asked there, but there is a certain component to the volume of, and kudos to the board, there's been a lot of policy work that's been done this year, which has taken an enormous amount of staff time, research, and implementation on those policies. I think one of the biggest buckets that we're looking at, if we look back to 2022, when there was a policy to bring all of our roads up that were fair and poor, to bring them up to good or excellent. It was envisioned that every year in 2023, 2024, and 2025, there would be a $2 million allocation for those roads. Was that not working? The vast majority of the roads that were in poor or fair condition were completed in 2023 and 2024, which left fewer roads to repave in 2025, even though there was a $2 million budget that was approved for those roads. We didn't come close to needing that much money. We have discussed that numerous times throughout the year through finance committee or board meetings. And we even used some of that overage to do flush curbing out in Ocean Park. And we intentionally talked about the savings from this year being applied towards repaving out in Ocean Park in 2026, assuming a substantial completion of the work there. There are other factors involved. There are new town ordinances and new boardwalk policy that force us to draft, design, and then redesign, and then undo and redesign again our boardwalk policies. So a lot of the time and energy that went into the design of the boardwalks initially all got undone and is now being redone. And in 2026, there's a substantial amount of money, including the savings from this year, that will be spent on upwards of 26 boardwalks being rebuilt this year. So there are reasons why the money wasn't spent. I'll give you another one for a different philosophy that we're using with our association reserve study. We're trying to more closely align the rebuild. I'll use Walk Bridge 15 as an example. This is the one at Atlantic Beach. The reserve study called for the superstructure to be replaced this year in 2025. And in reviewing, we had an on-site review of our association reserve in 2025. We looked at, does it make sense that we would replace the superstructure of Walk Bridge 15 in 2025 and then 2 years later have to replace the substructure? No, that does not make sense. That is not a good use of the community's money. So what we did was delay the replacement of the superstructure so that we could fully replace the entire structure. And we're looking at new materials that will last even longer. So we feel really good about doing that. But that required us to go to permitting, which we didn't have to do with the superstructure. We do have to do it with the substructure.
Look at it.
So Jody,
Hang on a second. It's a very good question. Not only is the aggregate spend significantly reduced, but 8 of the 11 categories have significant underspending. I have no concern, frankly, about the amount and or timing of the spend that we actually make. I have no concern about that. My issue is whether or not our ability to quote unquote budget for these kinds of infrastructure spending is inherently unpredictable. That's my question. In the normal course, would you expect that an annual budget would be within 5 to 10% of actual at the end of the fiscal year?
Shannon's saying not on the reserve.
So that's what we're trying to get a sense for. What sort of beta is reasonable for the community to expect vis-a-vis our MR&R budget?
I think the numbers that we have looked at in previous years on average was around 15%. It did increase substantially more than that.
Sorry, Jody. Okay, I don't want to pile on.
Well, could he just finish?
Last year we were 4.6
million
million versus 6.6 million budget.
Okay.
So we're under by 20%, 25% in 24.
Sorry.
I know you weren't around, so.
Yeah, so let's see, in 2022 was 15%, in 2023 was 15, it jumped up to 30 in 2024 and 33% in 2025. So what is a reasonable expectation? There are so many factors that influence it. The fact is the money still remains. Our number one goal is to continue to make sure that the amenities, common properties and all of that remain in good condition and are continuing to improve, which I think we're doing. But I can't nail down a number because there's so many environmental factors.
Yeah, Jody, or Jody, are you saying then that
inherently difficult to budget these types of infrastructure expenditures?
There is a methodology to budgeting, but that budget can certainly go askew based on whatever happens throughout the year, which we reforecast.
So much of it, the budget's only as good as the information you have at the time you're doing the budget. So if you're doing the budget in October, a year from now, when some of these expenditures are due to happen, a lot can happen in a year. One with availability of supplies, So from my perspective, a lot of the reserve budget, it's a little different than the operating budget in that the reserve budget is self-contained. It's exclusive. It's mutually exclusive of the operating budget. So anything that doesn't get spent in this year, in all likelihood, is just a postponement of those activities and expenditures. And if you build up to 98.5% of deterioration funded in this year, and as a big jump, in some level of likelihood, that will dip in the next year because you postpone those expenses. And I would say that 98.5% should be kind of qualified to a certain extent because in future years, there are significant expenditures above and beyond what we've been experiencing year over year. For example, wood bridges, those types of things, we may jump up to $17 million spend in a year versus the $4 or $5, $6 million that we're currently experiencing.
So much of the difference between the actual and the budget are timing issues.
Sure.
Easily explainable if presented in here. And we would not have to spend a lot of time here doing that.
It is explained.
I think I explained it in here.
Okay.
Yeah.
And what I'm more getting at is the trend. I mean, am I right in saying we're consistently under? And do we have a problem inherent?
I don't think we have a problem, but I know we recognized in 2024, we needed to bring another engineer on staff, which we did. Last year was his first year. I'm also new. So there are a number.
You're not.
Can't use that excuse anymore. But in 2025, it's a ramp up and there's some philosophical changes. But we are laser focused on the things that need to be done. It's also important to mention that there are allowance accounts in the reserve, which we hope.
Sorry, what sort of accounts?
Allowance accounts. So that, we budget a certain amount and hopes that we don't have to use them. But in case that we do, we'll go in and utilize those.
So, yeah. So, and therein lies the purpose of the forecast, because throughout the year, if we determine that, let's say in September, that we're not going to use those allowance accounts, we downgrade those in the forecast so that we have a more accurate reflection of what the spend's going to be.
So Jody, do you feel you've got the right resources either from a people or system standpoint to effectively manage what you're trying to do here?
Yes, I do.
Okay, okay, and then I guess Dale, what might be helpful, because obviously there's a timing element here, but especially as we start to think about the reserve study, is some qualitative, maybe some reference points of whether we're coming in favorable or unfavorable compared to costs, because we really can't tell in this whether it's timing or favorable, unfavorable project cost. So especially as we start to think about the reserve study, it might be helpful to have some, again, not GAAP accounting driven, but some reference points on where we're coming out on various projects once they're done.
Okay. When does Jody, since we have you here, what's the schedule roughly for the 2026 reserve undertaking project?
I just got the forms yesterday, so here we go.
And is this year an on-site?
No, sir.
It's a non-on-site year.
Right. Oh, it's going to be to the finance committee in May is the deliverable.
We'll look forward to it.
I'm open to questions, thoughts, comments. Again, the document is intended to be somewhat self-sufficient. I think it's worthwhile pointing out things, but then also entertaining
And,
thoughts.
and Dale, the last page will be that summary investment, performance summary from the Morgan Stanley.
That's the last page.
That's the last page.
I updated it this morning.
Okay.
And I will update it for when they send me the new version.
Okay.
And I'll just comment, it's great, Dale, you give us all this information, so good we have to give them.
Yeah.
Thank you.
Hey, Dale, one last question. If I did my math right, you ended the year with about 900,000 of cash. You obviously go into January and you don't have any, the assessments coming in until the end of January, beginning of February. But are you comfortable with ending the year around 900K, or should we be, as we're thinking about the budget for 27, be trying to build the cash balance you end the year at?
I'm comfortable. I do yeah, cash is probably the one thing that I concentrate the most on over time. And I'm comfortable with our current status.
I mean, I think we talked in previous finance committees last year about what the right level of cash should be to cover off on volatility and expenses. And I think we agreed $500,000 was kind of the number we all felt comfortable with. Is that right?
Well, yeah,
That was my recollection.
I don't think it was necessarily cash. I gotta think, I know what you're referring to, but I'm,
Okay,
I don't,
sorry.
can't pull that off the top of my head, but the operating cash is strictly
I think it was the year end, the delta, not the actual cash balance, but anyway.
Yeah. So anyway, one of the concepts that we talked about was, in addition, if we had a cash flow issue at the end of the year, which we haven't and don't, that designated balance could be that buffer, so to speak, because it could help us from an actual cash flow perspective that would get replenished within a month because of the assessments that are coming in.
Okay, Dale, could you give us a quick update on the 2025 audit and the 2026 internal control review?
Sure. So the audit, we've been back and forth with them quite a bit on preliminary type items that they can kind of check the boxes on. The actual data will go out today and tomorrow because in conjunction with this report, we've been finalizing and closing our year end. So wanted to make sure that was as complete as possible before we send all that to the auditors. We give them all the information up front so that they have basically a period of a week or so to act on it and then reach out with all the questions and comments. So most of our work is done other than that interaction, which is fantastic.
And is the team from Forvis the same?
Yeah, yes. So we had a new person, the lower, I don't know what, probably a senior, or I don't know what level he was, but that person was new last year, but that is carrying over. So there's
continuity.
Continuity, yep.
Okay, good.
And there's always continuity at the top, which is great. And then the internal control review, I've been playing a little bit of phone tag with Christy, who's the representative, and for the new members, that group is a completely independent group of the audit team. Same company, but separate group. And Christy is their senior partner, and she's moving from the latest proposal that the finance committee has approved, so to speak, into an engagement letter, and we're scheduling as we speak with regard to the actual review, and that is anticipated for sometime between March, when the audit has been approved, so to speak, by the board or accepted by the board, and probably May.
So when would we, the committee, have to be able to see the engagement letter or a draft of the engagement letter.
Once I,
No, but I'm
Fine.
just saying what would you expect the timing to be?
this is February, I would say probably by the end of the month.
Oh. Okay, certain by our next meeting, which is
Yes.
March.
Oh, yeah.
Yeah, okay, fine. Anything else? Okay, again, I'd like to welcome the new members. Very excited to have you join. As you can see, there are no shy people in this group, which is a good thing. And then finally, please do give some thought to your particular hot buttons, priorities, issues that you'd like to see addressed in the committee, by the committee, with the committee during the course of 2026. That would be very helpful, and Dale, including your own. So that's it from me. Thank you so much. And thank you, as always, to Dale and Olivia and your colleagues for the work that you do. Invaluable.
So, for the new members, Olivia is our controller and my right hand, so.
Okay, I would move for adjournment. Any objections? Let it be. Thanks, Dale.
Yeah, thank you.
Sorry, Dale, I didn't mean to
Paul,
get at you. It's just.
I will be out of town
No,
on the 12th.